Hey, I'm Steve. If you've spent any time at all looking at the markets, you've seen it, the red folder. So today, we're going to break down exactly what these high-impact events are, why they can be so incredibly dangerous, and most importantly, how you can navigate them like a pro. Let's get right into it.
And it's a warning you absolutely have to take seriously. See, a red folder, it means the biggest players, we're talking institutions, hedge funds, the high-frequency algos, they are all coiled like a spring, waiting for the exact same data point at the exact same millisecond. This is not business as usual. So let's talk about what's actually happening under the hood. The second that data hits, liquidity, the ability to just easily buy or sell, it can completely vanish. Poof. The normal price ladder you're used to seeing just disappears, and the spread, that gap between the buy and sell price, can absolutely explode.
And this right here shows you exactly what I'm talking about. On a totally normal day, the spread might just be a few ticks. No big deal. But during a red folder event, that thing can blow out to multiple full points. Trying to trade in that kind of environment without a rock-solid plan, well, that's just a recipe for disaster. So what are the big events that cause all this chaos?
All right, let's start with the undisputed king of all red folder events, the interest rate decision from the Federal Open Market Committee, or the FOMC. When this decision drops, believe me, everything in the financial world moves.
Now, here's why this matters so much. When the Federal Reserve decides to move interest rates, they are fundamentally changing the cost of money for the entire economy. It's this constant tightrope act, right? They're trying to tame inflation without completely tanking the economy, and this decision, this is their biggest weapon. The reaction in the market is instantaneous. You'll see Treasury futures, that's /ZN and /ZB, react first. A surprise rate hike can send the S&P 500 futures, or /ES, screaming lower, because suddenly that risk-free return on bonds looks a lot better. And the chaos doesn't stop there. The Fed's dot plot forecast and the press conference that follows, that can fuel these wild market swings for hours.
And this is the #1 rule. I want you to burn this into your brain. You let the initial chaos play out. Let the amateurs and the algorithms fight it out in that first minute. The real opportunity, it comes after the dust settles. You trade the market's reaction, not the headline number itself.
Okay, on to our second king, which is directly tied to everything the Fed does, the monthly jobs report. You probably know it as non-farm payrolls, or NFP. This number, it gives us a direct look at the health of the entire American economy.
NFP lands like clockwork, 8:30 a.m. Eastern, the first Friday of every single month. It is a direct health check on the labor market. A really low number, let's say under 70,000 jobs added, can immediately start those whispers of a recession.
But here's where it gets really tricky, and where a lot of traders get completely wiped out. Sometimes, bad news for the economy is seen as good news for the market. A weak jobs report might actually cause a rally, because traders start betting that the Fed will be forced to cut interest rates to juice the economy. This kind of inverted logic is a classic trap.
And that's why you can't just react to the headline number. The smart money, they dig deeper. What's the unemployment rate doing? And this is the big one. What about average hourly earnings? That number is absolutely critical because it tells you about wage growth, which is a key driver of inflation.
And that, of course, brings us perfectly to our third and final king of the red folders, the inflation print, also known as the CPI. This report has become the market's absolute obsession over the last few years.
CPI is basically the government's official scorecard for inflation. In today's world, with these complex supply chains and shifting global trade, every single tick on this report is put under a microscope by the entire financial world.
So here's the typical playbook you'll see. If CPI comes in hot, meaning it's higher than economists were expecting, the market immediately assumes the Fed has to keep interest rates high for longer. What happens next? The US dollar index, or DXY, often spikes higher, while assets like gold and the S&P 500 take an immediate nosedive. But just like with the jobs report, the pros look past the headline. They focus on what's called core CPI. By stripping out the really volatile prices of food and energy, core CPI gives you a much clearer picture of the underlying inflation trend in the economy.
Look, I can't be any clearer about this. Of all the red folder events, CPI is arguably the most violently volatile. Holding an unhedged position into this number isn't some calculated risk. It's a coin flip. It's pure gambling. Period.
So, we've identified the three kings that can absolutely wreck your account. Now for the most important part. How do you actually prepare for them? It all starts with the calendar.
You don't wait for this stuff to hit the news. You go straight to the source. The two industry standards that everyone uses are Forex Factory and Investing.com. They're fast, they're reliable, and best of all, they color code all the events for you.
And here's your simple, actionable game plan. Go to one of those sites, open up the calendar filter, and set it to show only high-impact red events for the USD. That's it. This cuts out all the noise and leaves you with only the data that can truly move the market.
This has to become a non-negotiable part of your daily routine. Before you look at a single chart, before you draw a single trend line, you open that calendar. You have to know the economic terrain for the day before you even think about placing a trade.
So let's bring this all home with this single most important takeaway. If you only remember one thing from all of this, make it this. It all comes down to respect. Respect for the data.
At the end of the day, successful trading is really just about risk management. Think of these red folder events as predictable storms on the ocean. You don't have to sail right into them, but you absolutely 100% have to know when they're coming. Because knowing when to stay on the sidelines, that's just as important as knowing when to trade. So watch your calendar and always respect the data.